Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this trading week has been slightly shortened in the US due to markets being closed for Martin Luther King Day, but when US markets did reopen on Tuesday, the sell-off in US Treasuries was reignited. Now, if you recall last week, I explained how the rally in bond yields, as investors placed bets on higher inflation and therefore higher interest rates, had sparked an equity market tremor with the epicenter in US technology stocks. Now, by that point, the Nasdaq 100, which is a very tech-heavy index in the US, it was down around 2.54%. At that point year to date, while the S&P 500 was down almost 1%. Now, in Europe, equities were broadly flat, but UK assets were the standout performers. The FTSE 100 was up 2.26%, and I asked the question of whether 2022 would finally be the year when UK and European equities outperformed US equities. Now, something like that for UK equities has only happened once in the last 10 years. So that gives you some much needed context on that. But by Tuesday this week, which was yesterday as I make this video, investors seem to ratchet up their bets on the level of monetary tightening that the US Federal Reserve will be forced to take in 2022. It certainly seems as if the bond market has finally begun fully pricing in 4 rate hikes from the Fed this year. Previously, the projections from the Fed policymakers have been for there to be 3 rate hikes in 2022, but some quarters, namely the chief executive of JP Morgan, have even suggested that there is a pretty good chance of more than 4 rate hikes and even as many as 6 or 7 this year. And it's perhaps unsurprising then that as I make this video, the 10-year US Treasury yield has rocketed and has hit 1.9%, which is the highest level since December 2019. Now, the repricing of the bond market, which is the largest and most liquid of investment markets, led equity markets lower. Now, technology stocks took a renewed hammering in a now familiar pattern that I've described in recent weeks. The Nasdaq 100 tumbled a further 2.6% on Tuesday, meaning it had fallen more than 7% in 2022. Now, the wider Nasdaq composite crashed down through its 200-day moving average, which is traditionally a very bearish sign. But while the stress is finally showing at an index level on US stock markets, there have been signs of weakness beneath the surface for a little while. Right now, 70% of the stocks in the Nasdaq composite are down more than 20% from their recent highs, while 40% of stocks within that index have fallen more than 50% from their recent highs. Now, not many people have actually noticed that. Until now, the big tech stocks that have driven most of the wider index's performance have obscured what's been going on beneath the surface. So the Nasdaq composite is just a hair's breadth from a technical correction, which means a 10% fall from its recent high. But the weakness in equities hasn't just been confined to tech stocks. So on Tuesday, for example, every sector in the US was down except energy stocks. Now, what has compounded things is the price of oil also hitting a 7-year high as geopolitical tensions in the Middle East and Europe threaten to disrupt oil supplies in Russia and the United Arab Emirates. Now, this has pushed inflation expectations even higher and seen Russian assets slump in recent days. In fact, if you looked at the Russian stock market, it's fallen 14% in just 4 trading days over fears that Russia may be planning a renewed invasion of the Ukraine. Well, Chinese COVID restrictions aren't helping either because they are starting to pose a threat to global supply chains once again, which again fuels that inflationary concerns. Now, recent corporate earnings have also been a bit of a problem as announcements have been underwhelming. Now, on that latter point, we have now entered earnings season where investors focus on the Q4 earnings of 2021 that were announced by companies, particularly in the US and Europe. And it's traditional that bank stocks tend to kick off earnings season in the US, and that's what happened at the end of last week into the beginning of this week. But a number of disappointing reports saw bank stocks slump. So JP Morgan Chase and Goldman Sachs, for example, their share prices fell over 6% after their earnings reports were released. Now, ironically, bank stocks and financials have been the very stocks that investors have been rushing into as part of the reflation trade rotation that we've seen since the beginning of the year. Now, those disappointing earnings surprised the market and pulled the rug from under it. So this became more than just a higher interest rate, higher inflation, reflation trade story that we've had for much of 2022. So concern began growing that central banks will raise interest rates too aggressively in 2022, especially in the US, and kill the bull market. Now, something I said that last week, if you remember, the currency and bond markets were already starting to point a finger at. So this week, it seems that equity investors have just played catch up. But earnings season has only just started. So in the coming days and weeks, this is likely to influence the market direction in the short term. And whether that be good or bad, we'll have to wait and see. But once again, the pain isn't being felt in the UK to the same extent. In fact, that's even despite the UK political issues that we're seeing in Westminster. Right now, the FTSE 100 is up 2.45% year to date. Compare that to minus 4.6 on the S&P 500 and minus 7% on the Nasdaq 100. Then you can see there's a huge outperformance of UK stocks and assets. Now, when you look at Asian equities and emerging markets, they are just about keeping their head above water as well. And if you compare that to the broader equity market measure of the MSCI All Country World Index, that's down over 3% year to date. So you can just see there's quite a disparity in performance of equity markets, with the UK outperforming quite considerably already in 2022. Will that stick? We'll have to see. Now, the question still remains as to whether the weakness in US equities will eventually bleed over to this side of the Atlantic. Now, history suggests that it will do eventually if the weakness in US stocks continues. Now, the bull market and uptrend in US stocks is a little bloodied and is being tested right now. And what happens next matters to the whole world. Now, we've broken back below 4,600 again on the S&P 500. So make sure you keep your eyes on those December lows of 4,500 to 4,530, because if the weakness continues, those levels will be important, as that would be a logical place for investors to come back in and buy this dip if they in fact are going to. So that is it this week on Damien's Midweek Markets. As ever, you can contact me. Damien at moneytothemasses.com is the email address. Twitter, Money to the Masses with the number 2. We're on Facebook, Instagram, TikTok, and of course, don't forget to subscribe to our YouTube channel.